Okay, good morning, everybody, or good afternoon, wherever you may be. I am Rob Thummel, Senior Portfolio Manager at Tortoise Capital, and I am joined by my colleague, Mark Marifian. And you've probably seen us before to talk about our latest webinar, but we titled this one, There is no AI without, or there is no AI without infrastructure. And I was just on CNBC yesterday with Brian Sullivan about this time, actually, talking about this exact concept. And so this is a topic that we have been talking about quite a bit. And for those of you who have listened to us before, you've seen a lot of the materials we put out at tortoisecapital.com. But Mark, why don't I just turn it over to you real quick just to explain a little bit about the high level on the product itself.
Yeah, thank you everyone for joining us. My name is Mark Marifian. I'm head of product here at Tortoise. Today we're going to talk about TCAI. It's our Tortoise Capital AI Infrastructure ETF. We go to the second page. Yeah, this fund really is a total return focused approach, and put simply, it's we're investing in infrastructure that makes AI possible. Now, I think we started to come around on this a bit, but I think when investors first thought about AI, they really think about semiconductors, they think about software, or AI applications. For us being infrastructure guys at heart and energy guys, our approach is a little bit different. The simple approach was what physical infrastructure is going to be required for AI to function at scale. And so, that led us to a little bit different answer. You think about power gen, data centers, cooling infrastructure. So Rob's going to get into all this, but these are some of the critical assets that we were thinking about when we were thinking about AI and launching a strategy. If we go to the next page, yeah. So this is kind of our tagline here, if you will. AI is the brain, infrastructure is a nervous system. TCAI invests in the system, and one of the phrases I would say we frequently use is that AI may be the brain, infrastructure is that nervous system. Again, we think TCAI, think about that as really the enabling layer of infrastructure that's allowing AI to be possible. And we think there's going to be long-term opportunities that exist here with AI models and AI software, but we know that none of this happens unless the infrastructure build out were to occur. A lot of people have put it succinctly. One way I like to think about it is we're investing in the picks and shovels of the AI revolution. And then Rob, we can go to next page. We can go to just very brief overview. I think rather than this will be a theme I think we want to reiterate a few times, but instead of forcing investors to choose between power or data centers, the network cooling, all the different infrastructure you can think of, we're going to allocate capital really as the opportunity set and conditions arise. And so we think active management is really, really valuable here. Particularly as the market's going to be changing. You can have leadership trend changes, and you're going to want to be able to be nimble across the different parts of the AI infrastructure stack. So again, this is something we saw back in the day with energy and the evolution of shale. But again, this is all lending credence to how we came up with the AI infrastructure idea. Again, ticker's TCAI. We launched this August 4th, 2025, so it hasn't been quite a full year, just over 10 months. And the expense ratio is 65 basis points. So Rob, I gave a little bit teaser as to the origins, but I'd love for you to voice over for everyone how we arrived at the idea for TCAI and what you and the portfolio team did.
Now, this has been an exciting journey for us on the portfolio team at Tortoise. I've been at Tortoise for over 20 years. I've been part of all the product launches at Tortoise that we've done. We've tried to be innovative in every way, and I think this is another one of our innovations. And we had I had a supporting management team, and a supporting product committee, and this is an exciting one. A lot of you this goes back a relatively long while. It's just a couple of years, and in AI time, that's a long time. But we first started looking at this in early 2024. I still remember when Toby Rice, the CEO of EQT, told me that John Arnold had been named to the board of Meta. Not a lot of you probably know who John Arnold is, but he's kind of a legend in the energy business. He's been a natural gas trader. I think he was one of the youngest billionaires ever. He came out of Enron, I believe, started up his own hedge fund. Wildly successful, obviously a really brilliant guy. But when I saw in, I think it was January of 2024, he was appointed to the board of Meta, I thought, well, that's interesting. I wonder why that was. And then shortly after that, we had Toby Rice, the CEO of EQT, on a conference call, one of our webinars that we typically have, where we highlight some of the CEOs that we've known over the years. And Toby mentioned it on the webinar, and I went back and looked, and I thought, wow. Okay, well, I find, it clicked. It's like, okay, there's something happening here. And Toby, even on that webinar, also talked about, hey, there's this AI thing happening. And, just a couple years before that, in November of 2022, ChatGPT was launched. And, we all know about that today. I mean, today, I think there's over 1 billion users. There's been multiple other chatbots. And so AI was on its way. And so we decided, Mark and I and Matt Salee and some of the other portfolio managers here at Tortoise, we decided, well, what do? We need to learn more about this AI. We need to write a white paper, which is what we did. Now, I think that white paper still exists. Well, it still exists. I think it's still digitally on our website, and I always like to go back sometimes and look and see, what we talked about. And in that white paper, we talked about the origin of and the history of AI, and Jeffrey Hinton, who was I think the founder of AI, and how NVIDIA really sped up the development of AI with its chips, and so on and so forth. But ultimately, what we decided to do is what Mark said, is we made an internal decision to pursue an AI infrastructure active ETF, because when we looked at everything, we looked at everything that was going on in AI. We said, hey, look, this the characteristics of a lot of the companies and that we're looking at investing in really are very similar to some of the characteristics that we've invested in infrastructure at Tortoise for over 2 decades, right? Right. And what am I talking about? Well, I'm talking about long duration cash flows. These are really essential assets. They're hard assets. They're not technology assets. They're hard assets. They're real assets. They do have long duration cash flows. They do have high quality counterparties, and contract durations that are in some cases not just months or days, but in a lot of cases years, and sometimes decades. So that's really how we got started, and developed the product, and then we turned it over to the team, right? And that's where the investment team became involved. And that's where it really got exciting, and we'll talk about a little bit more about that in a second. But the team we have here to manage this product is really four senior portfolio managers: myself, Brian Kessens, Matt Salee, James Mick. We've all worked together for over 20 years. We've got four other or additional investment analysts that really jumped in and dove really deep into this AI infrastructure opportunity, and have had a lot of fun with it. They're obviously younger than me, but of course everybody is here at Tortoise. But that really allowed everybody to see the opportunity we had here, and I think that's really been what's part of the success. Now, look, we use the same investment process to go about looking at this portfolio that we've used for every one of our products at Tortoise, and really the same investment process that we use for everything that we do at Tortoise. You could think of it a little bit as a bottom up and a top down process, but we developed the universe. I think there was $5 billion of market cap of securities we looked at. I think there were almost 200 publicly traded stocks that we looked at, and then we started breaking down these stocks and these securities, and putting them in subsectors, right? And we and evaluated each one of those subsectors, and we looked at each one of those subsectors fundamentals. We looked at things like supply and demand imbalance. We looked at things like valuation. We looked at sentiment, and we signed a rating. to each one of those subsectors. If it was a +1, it was a favorable subsector. If it was a 0, it was a neutral subsector. And if it was a -1, it was an unfavorable subsector. We'll talk a little bit more about then how we ultimately formed the portfolio. But ultimately, what we found as our team, both at the senior level and at the analyst level, found is we were looking for companies where the market really was structurally undersupplied, but they had accelerating growth. So let me repeat that. So we were looking for markets that were undersupplied and with accelerating growth. You say, well, what does that mean? Well, we've seen this at Tortoise in the oil markets for a lot of years, right? When the oil market gets undersupplied, but yet the demand or the growth continues to grow, well, what happens? Well, prices go up, cash flow goes up, and a lot of these companies do really well. We've seen the same thing in the development of infrastructure when there's been a shortage or scarcity in infrastructure, right? Not enough pipelines are being built. There's a basis differential or something along those lines, and there needs to be an outlet for that oil or gas. Well, same concept. Those markets are structurally undersupplied, but the growth for that oil and gas in this case is growing, and so that has been an opportunity for, in this case, in infrastructure, for fees to either be increased or sustained for and contracts to be added along to. So that's the kind of stuff that we're looking for. Is we took some of the similar principles that we've been using for the last 20 years and applied them here, and invested and launched this TCAI product in August of last year. We launched it with virtually nothing, and Mark will tell us later today that where we are. I'll save that, or Mark, maybe you can tell us right now. Where are we now on TCAI from an AUM perspective?
Yeah, no, it's been wildly successful. We've today we're over 250 million in assets, and we seeded it with 500,000. So it's clearly something, Rob, that I think that the market was able to easily digest, and I think there's still understanding and learning about the story. So we're excited to really. I think today is going to be fun because what we're going to do is really pull back the curtain in terms of. We'll have a couple of very high-level macro slides at the beginning that Rob will work through, but then we're going to walk you through some how we were thinking traditionally about setting up the portfolio initially, where we evolved to a bit, and then we'll do a couple case studies as well on some of the success stories within the portfolio. So and one thing that I missed. We'll also define what the AI infrastructure stack means. I think that's critical as we're all learning about AI and how it's rapidly developing so quickly. So again, just want to be as educational as possible and just kind of help everyone understand what's going on behind the scenes here, at least with TCAI. I would say for those who have not joined us before, welcome, and I would also say. We will take questions, so do feel free to type those in to the chat at the bottom, and Rob and I will get to those at the end of the presentation. So, Rob, let's continue to move along here. Next slide. This is one that you have had in for some time, really. Dating back 2-3 years, and boy, has it evolved. But I'll let you talk about it.
Yeah, no, absolutely. So this is probably one of the primary drivers of this fund of our TCAI fund, and really of the market in general. A lot of people, a lot of you have already seen this slide. The CNBC flashes these numbers up all the time, talks about all these numbers. We watch them very closely. What are you looking at? Well, what you're looking at is the annual capital spending by the hyperscalers. Who are the hyperscalers? These are the largest really AI companies that are creating the AI applications. So we're talking about Amazon, Google, and Meta, and companies like that. So what we look at and we track very closely is we've gone back to see how much are they spending in capital, right? And when Mark and I did this webinar back in 2 years ago, they were spending, these hyperscalers were spending or expected to spend about a little over $200 billion on AI capital spending. But we've all seen what's happened with hyperscaler CapEx. It just keeps going up and up and up and up. And that's what's represented here. It's gone from 200 to 400. This year, it's probably going to be close to 700 billion, maybe 800 billion. Some think it could reach a trillion very, very, very soon. And if you believe Jensen Huang, who's probably closer to it than anybody, he thinks that hyperscaler capital expenditures on an annual basis could reach $3 to $4 trillion sometime beyond 2030. Now, why does that matter? Well, where's that money's being spent? We'll talk about that in a second. But the growth rate, the underlying compound annual growth rate of this capital spending is obviously well over 20%. In some cases, it could approach 30%. And depending on how big it gets, it could be 40%. That growth rate is what will basically mirror, we think, the growth rate of many of the underlying companies that we're investing in TCAI, because a lot of that capital is being spent on the investments that we're making in TCAI and the products that they offer.
So Rob, let's get into the stack itself, and that here is, and this is I know you like to use Jensen's analogy here, so it'll be a good one just to walk through for everyone.
Yeah, so a lot of people say, yeah. Where do you participate in the stack, right? And I'm not exactly sure what they're referring to exactly, but here's how we look at the stack, right? We look at it. Jensen Huang a while back called this the 5-layer cake, where every single application depends on the layer beneath it, right? It starts, the base layer is energy, right? And so we look at a lot of these energy stocks, right? And obviously, Tortoise, we've been around looking at these energy stocks for 20 years. This is what got us into this, looking to this AI opportunity. But we've been looking at independent power producers, natural gas infrastructure, power grids, energy infrastructure, storage, all for a long time. Nuclear as well. And that's the essential. That's the base level, right? And in some ways, the work, Jensen Huang did some of the work for us initially, because he said, look, the one area where I see a bottleneck initially is energy, power. I think we'll talk about that, but I think that in some cases that's still the case. The next layer up above that is infrastructure, right? And I'm talking about not energy infrastructure. I'm talking about digital infrastructure. This is an area that I don't think gets discussed enough, but this is where we spend a lot of time on, because we think the digital infrastructure is going to be really just as critical as the energy infrastructure in ensuring that the U.S. wins the AI race, global AI race, and that all these AI applications come to fruition. So what I'm talking about when I think about infrastructure, I'm talking about data storage devices. I'm talking about data centers themselves, right? These data centers are massive, right? They're sprinkled all over the country. You've heard about a lot of them. They've been named after Greek gods, Prometheus and Hyperion, and effectively they're being built because we can't get enough data. Well, we really can't get enough data centers to store the data to really develop all these applications. And so when we think about the infrastructure, we're talking about the data centers. We're talking about liquid cooling, right? And we'll talk a little bit more about what is liquid cooling. But liquid cooling is important. We're talking about the network switches. We're talking about the cabling. We're talking about the construction and the engineering and the companies that are actually fulfilling all these obligations. Back to what Mark said earlier. This is the picks and shovels. This is not the sexy stuff in the technology stack. This is the picks and shovels. This is the absolute essential that's really needed in order to for these AI applications to evolve. And so if you're like me and you believe that AI is going to be the next industrial revolution, and that AI is going to drive the next economy, well, we're going to need a lot of all of this. We're going to need a lot of energy, because what's going to happen is, as Jensen talks about, the applications. We're going to have a lot of AI applications, and we can talk about where we're going there, right? Today we probably all, I think I didn't bring it with me, but almost everybody uses AI in some shape or form is part of your day, right? Whether you wake up with an Apple Watch or do some search on the internet, on Amazon, or use Netflix and let it decide what show you should watch. Every day, AI in some shape or form is ingrained into our network or into our daily lives. Almost 24 hours a day. It's probably going to get even more, right? I mean, we're talking about longer term. What are we talking about? We're talking about robots, right? Elon Musk wants us all to pay $20,000 for a robot. I'll wait till the price comes down a little bit, but maybe someday we'll have a robot. We're talking about autonomous driving cars. We won't ever have to drive ourselves anywhere. Um, all of that is AI driven, and it's going to require more of all of this. It's going to require more power. It's going to require more data storage. It's going to require more data centers. It's going to require more liquid cooling. It's going to require more cabling. And all of that's what's really we're going to see play out over the next several years.
Yeah, all that is anchored really in the demand pull for electricity. Rob, if we go to the next page, and we have a couple pages here on what the initial portfolio looked like. Maybe you can quickly run through what we saw, the portfolio anchored on in infra and energy, and then we'll kind of go through the different segments of the AI portfolio.
Yeah, so if you think about really what is AI, not a lot of people think about this when you click that button on ChatGPT and you use your AI or Claude or whatever you may choose. But at its essence, at its core, AI is really just it's energy and it's data, right? And so the energy component is something that's really important. Like I said, when our team dove in, and we started with energy because that's what we knew the best, and we kept hearing these companies talk about AI, and the future demand. But who is going to stand to benefit the most? And like I said, that goes back to fundamental security analysis, and we looked at those companies that had or those markets that were structurally undersupplied but had accelerated growth. Here's a couple examples of them right here. Right, in energy, we focused on the independent power producers. Right, the independent power producers. Who are those? Those are companies like Constellation and Vistra. They operate electric generation facilities in markets like PJM and ERCOT. And if you're not familiar with PJM and ERCOT, these are the core electricity markets, regional electricity markets, where a lot of these data centers are being built, and this electricity demand is rising. And if you go back to the paper that Mark and I wrote and the white paper that we presented to you a couple years ago, you saw and you'll see the tremendous expansion and increase in the demand for electricity that was expected, and it's it's kind of following along that path. In fact, it's accelerated in terms of the electricity demand there. But these companies, they basically operate electricity in markets that are short electricity. So they're operating in Pennsylvania and West Virginia and Texas, right, and Virginia, where the market for electricity is growing and it's undersupplied, but the pace of growth is accelerating. And so when we set out to set the portfolio initially, kind of following along Jensen Huang's energy being the foundation of AI, we focused on the electricity and the power, and started investing in independent power producers, and then in electricity generation, the companies that had the electric generation facilities that were in the core areas of where these data centers were being built, like a Dominion Energy. Then you go backwards and you keep looking and say, oh, how far does that extend? Well, you've got to have energy infrastructure, right? You've got to have energy infrastructure because all of this electricity generation has to be fueled by something. And energy infrastructure, as many of you know and have invested with us in, which we appreciate you for, is that's the core driver of electricity demand is going to be natural gas. We think that natural gas, which represents the largest component of energy demand right now, at least from a fuel perspective, will continue to grow, and the pipelines that we're investing in will continue to see substantial growth in energy demand because of electric generation tied to growing AI demand. And we've started to see the pipeline network expand as well. Once again, back to that concept. The pipeline network is structurally undersupplied, and we've got growth that's coming in because more natural gas is needed to be transported. And so what's happening? Well, we're seeing companies like Energy Transfer building new natural gas pipelines. We haven't had any new natural gas pipelines built in a long, long time. Energy Transfer is building brand new natural gas pipelines in West Texas to take natural gas from West Texas, where the price of natural gas is below $1.50, down to Arizona, because Arizona has a growing, obviously just population, but also a growing demand for natural gas and electricity because there are a lot of data centers being built and there's a lot of industry being built. And so that's just an example, one example. Another example of energy infrastructure that's necessary that we uncovered, and we've talked about it, and we've written some white papers on this too as well, is behind the meter power. A company like Williams, a longtime holding here at Tortoise, and if you're invested with us, you'll see Williams at the top of your list of securities. Williams is doing some really, really innovative things to help support and grow AI demand. And what am I talking about? Well, I'm talking about behind the meter power. You're saying, well, what does that mean? You've heard the president and others talk about, hyperscalers, you need to bring your own power. What does that mean? Well, that's like behind the meter power. When you build a data center, you need to make sure you have that power secure, because the regulatory bodies all the way up to the top are not going to allow the local citizens in those communities to pay for that power. Instead, innovative solutions that are provided by companies like Williams are really opportunities for companies like Williams as well, because what they do is they use their extensive natural gas pipeline network to build to build the actual electric generation facilities that run off natural gas, and enter into a long-term contract with a hyperscaler themselves, and that contract is simply between Williams and the hyperscaler, and that prevents anybody in the local community from having to pay for that power. And so that's been an innovative solution by infrastructure as well.
Well, wonderful recap on the energy side, and that's just part of it, right? Because now we got the digital infrastructure, Rob, and that these subcategories really have emerged over the last 12 plus months. So hoping you can give a little bit more color on some of these names as well that have entered into the portfolio.
Yeah, this is a good question, and people often say, what do you guys? You guys are energy guys. Rob, you've been in energy 30 years. You say, well, what do you know about the technology side? And I say, what, I'm not going to tell you about the applications and what next new hot application is going to come out, and but what I'm going to tell you is, like I said, what we've been good at Tortoise here is identifying these structurally undersupplied markets that have accelerating growth. And so we just talked about some of those for energy, but that same concept also applies to what I'm going to call digital infrastructure. And we've listed them out here. So data storage, right? The storage devices, right? At the heart of AI, as I mentioned earlier, it's data and it's electricity. And you can imagine how much data storage we need. And so data storage, there's a significant demand for data storage because that's what's needed to advance this AI, the AI phenomenon, I guess, both domestically and globally. Network switches, right? Inside these data centers, you need to move around that data as fast as possible. And companies like Arista are doing it with these network switches. Speed is key. We're going to talk about that a little bit more later, because speed is key. These data centers, they get really hot. Inside these data centers, they probably gets up to close to 200 degrees. So they've got to keep these cool, right? There's all this fancy equipment inside there, and all this expensive infrastructure. And so companies like Vertiv. You may not have heard of these companies. A lot of these companies you probably haven't heard of. They just got into the S&P 500. They haven't been in the S&P 500 forever. But companies like Vertiv are really, really important infrastructure providers to these data centers. And to this AI development, because we're going to need to keep this equipment cool on the inside. Because if you don't do that, then obviously we all know what happens. It's the lights go out and your chat GPT doesn't work, which nobody wants. Companies like Ciena, network cables, right? Cabling, right? Millions and millions of miles of cables spread across throughout all these data centers is absolutely critical to keep these data centers going. The speed at which the data travels over these cables is really important. And there's some innovations that we can talk about later on that's happening in network cabling to help improve the speed at which this data moves across these cables. And those are investment opportunities in and of themselves, because fiber optic cables, that are predominantly copper are still predominantly used, but there's some new innovations here that we've been studying and following and are exciting, and we've actually made some investments there as well. And then, of course, lastly, the data centers themselves. The data centers themselves are absolutely critical. They're about. I mean, I think it's pretty clear that they're one of the anchor tenants here. I mean, if you think about data centers themselves, they're undersupplied, or they're operating in a market that's really undersupplied, and demand's growing a lot. And so what we're seeing is all demand for these data centers is resulting in is companies like Digital Realty and Equinix. They're able to go out and with their customers and extend the contract base. Well, first of all, raise rents. First of all, number one, they raise rents, and then they extend the duration of their contracts for more years. Sound familiar? That's a lot. What was happening with a lot of the pipelines that we've invested in over years as well. With as pipelines became more scarce, well, what happened? Rates went higher, and the contract durations went longer. That's exactly the same thing that's happening with data centers right now.
Yeah, Rob, another great overview. I mean, just the broad breadth of subsectors just amplifies really the opportunity set in the sandbox that the portfolio team has to look for investment opportunities. So I've seen this portfolio kind of develop over time, and we've also done some. I don't want to shortchange you guys, but you guys have done some good old fashioned securities analysis too, and you've come up with a few winners there too. So I figured we'd just spend a minute or two talking about some of that.
Yeah, real quick on we kind of gave you an idea how the portfolio was anchored on energy and infrastructure, and then but some of the specific ideas of how we got there. On the energy side, electric utility side, we looked for what I'll say is we went and did your traditional securities analysis, and we looked for accelerated growth stories. Right, it's pretty simple, right? That's why I say it's kind of basic securities 101 analysis. And we looked for companies that were going to demonstrate an accelerated growth story that could possibly cause their stock to re-rate. And in this case, we found three. Evergy and Entergy are a couple great examples. Those are local utilities. Evergy's our backyard utility here. It's also the utility to Travis and Taylor, Kelsey and Swift, whichever way however you want to go by. And that company has been around for decades and growing at 1 or 2% a year. But because of all of the activity around here in Kansas City, and Kansas City growing its data center activity, Evergy has been able to expand its load growth from 1 to 2% to 7 to 8%, and that stock actually, if you look at it, has performed relatively well because of that. Same thing in Entergy, right? Entergy is really a unique story. It's a northern Louisiana utility. If you look at that story, it's the same thing. That's where I think that's where one of the Meta facilities is being built. A Meta data center campus is being built actually, and Meta as a result of deciding to expand and spend billions and billions of dollars in northern Louisiana, really has expanded Entergy's load growth profile from 2-3% to now 7 to 8%. So you've seen growth in the multiples as a result of these old utility companies that were slow growth to no growth. Well, they've now become medium to, in some cases, higher growth. Similar things happening in things like at a company called Modine. It's one of my favorite examples, and I've talked about it a lot on some of these shows, CNBC and Yahoo Finance. Modine is is a 100-year-old company. Modine is a manufacturer of radiators, right? For farm implements. They've been doing that for years. But they also manufacture cooling systems, and they provide cooling solutions, including liquid cooling. And they've really transformed their company and really reinvigorated their company because as a result of data centers and data center growth and the fact that there's so many data centers growing and being built, and that the liquid cooling market is an undersupplied market that's structurally undersupplied and it's experiencing a lot of growth. The Modine has gotten into this business using its existing facilities. It's been able to grow and advance its growth rate by 20% plus. And we've seen that stock perform pretty well as well.
And Rob, I think next page has some transformation stories. Modine's on here, but I think we can also talk about the Bitcoin miners, right?
Yeah. So if we go to the next page, this is one we're really excited about. This is one where you roll as securities analysts and portfolio managers. You dream of these days when you find these stories. And I guess we're just kind of stock nerds, but these are fun times when you find the needle in the haystack. And I just talked to you about these. I'm going to call them transformation stories. And what I was talking about with Modine is the transformation story of it being obviously being a provider. Moving from a radiator manufacturer to transforming into a liquid cooling provider for these data centers. Another example, though, we found is in these Bitcoin miners. And these Bitcoin miners are really unique. And you say, well, why are you even talking about Bitcoin miners? And what are they? Well, obviously they're mining for Bitcoin down in Texas and Louisiana and other areas of the country. But we didn't invest in the Bitcoin miners, and we didn't uncover them because we're interested in Bitcoin. We have no interest in Bitcoin. What we have interest is in energy and electricity. And back to our simple mantra of we were looking for structurally undersupplied markets with accelerating growth. Well, what's that? That's the electricity market, right? What did these Bitcoin miners offer? Well, they were some of them maybe lucky, but I would call them somewhat creative. And sometime maybe we'll have a webinar with one of these Bitcoin miners and they can explain how they were thinking about it. But a lot of Bitcoin miners built electric generation facilities or built Bitcoin mines in South Texas or in Texas to take advantage of cheap natural gas and electric generation that was cheap to mine for Bitcoin. But then they realized, oh my gosh, you know what? We've got customers that would be willing to pay us to convert our Bitcoin mining operations into a data center. And so what you saw is major hyperscalers, Amazon, Google, they would enter into long-term contracts for billions of dollars, 15-year contracts, billions of dollar contracts, and these Bitcoin miners would convert their Bitcoin mines into data centers, basically. They did this, and they were and these Amazon and these large, healthy hyperscalers were willing to do this because they needed access to electricity. They needed access to electricity now. It's kind of like, to me, it kind of reminds me back in when the shale revolution was evolving, and big producers like Chevron and Exxon were entering into these long-term contracts with these small little companies. At the time were small little companies called Targa, right? Targa grew and has been wildly successful gathering and processing oil and gas. And they did it because they had the facilities and they had the expertise, basically. And they were then able to scale that business. Same thing's happening here, except it's not Exxon and Chevron. It's Amazon and it's it's Amazon and Google that are partnering with these Bitcoin miners. The Bitcoin miners are kind of like the Targas. They have these weird names like Wolf and Riot Platforms and things like that. But it's those Bitcoin miners that are getting these multi decade contracts with high quality counterparties for billions of dollars to effectively provide electricity so that the hyperscalers can continue to advance their AI applications.
Great examples. We got one more for everyone. Really just diving deep into the portfolios. Hopefully you guys are enjoying some of these stories. But this has been a fun one. Everyone knows Dell, right? So Dell has had quite the transformation, as you can see, and that's started to be reflected on the stock chart. But Rob, I'll pass it to you to talk about a little bit
Yeah,
more about Dell.
I'll be quick. Dell's one of our exciting stories as well. Dell. Everybody thinks about Dell. You think, oh well, I've got a personal computer. It says Dell on it, and they're a personal computer maker. Yeah, that's what they've been. They've been that for a long time. Obviously, Michael Dell's been wildly successful in that. Um, However, what a lot of people didn't realize is that the Dell is actually much more than a personal computer maker. They're actually contributing to really the development of AI in a major way, and actually building what I'll call AI factories through their servers for lots of small and medium-sized businesses, as well as a lot of governments. And so you can see kind of this annotated stock chart here. If you go back and you look at Dell in 2022, and they had roughly $6 of earnings per share, and $34 billion of network revenue. And we started looking at Dell and buying Dell when it was about $140 a share. That was I guess sometime in 2024. Well, most recently, Dell just reported. Actually, the stock actually rose to over by 33%, over $400 per share, because it reported the segment that it has now that relates to AI, its AI optimized servers, increased its revenue by over 757%. And it raised its revenue guidance to $44.5 billion, and EPS guidance by 74%. Well, the net result of all of this is obviously the multiple in Dell when we bought it was at 7.5 times. Now it's 20 times. And we think that that's probably too low, because we think that Dell is still being viewed, generally speaking, as a computer manufacturer, when in fact it's one of the leading edge server providers for AI. And if we're going to incorporate robots, if we're going to incorporate autonomous driving vehicles or into our lifestyles, and that's where AI is headed, well, then these Dell servers and these AI factories that Dell is building are going to play a really critical role.
Yep, it's a wonderful transformation story, and you can see it in the earnings power. One more slide on Dell, Rob. I don't know if you have anything on this one. A little bit of a repeat, but
yeah, let's just go to the next slide, Mark, because that's exactly what I just said. So I won't repeat it for everybody. So how are we positioned, Mark? Maybe you can talk a little bit about. You're the product guy. Let's talk about how we're positioned.
yeah, I mean, look, I would say Dell, one thing to note there, Dell has been consistently a top holding in the portfolio. So that was when we initiated really at the beginning of the launch of the fund. As we set out the portfolio, you can see how we're split with the allocations today. 27% in energy, 14% in data centers, and really a lot of that shifted into the Bitcoin miners. And then the bulk of the portfolio today is in digital infrastructure. So, I think that the beauty of this portfolio is that as the market changes, as opportunities changes, there are no guardrails, if you will, in terms of set portfolio allocations within these three groups. The portfolio team will really just be able to go find the best opportunities that they see, and those could change certainly over time, particularly as the infrastructure story starts to mature.
Okay, I agree with that, Mark. And then I'll let you do this slide, because how have we done?
Yeah, no, it's been quite the ride. So 114%, since inception. Calendar year has been even, very strong, 82% year to date. What I would point out to everyone is that there are a lot of AI funds out there today, but when you look at the AI universe of ETFs, you're looking at about $100 billion now with market appreciation, 50 plus ETFs on my screener. So you're seeing really a large growth and proliferation of product. But I would just say that yes, some of them will have the AI name in them, but you can get really wildly different results. I mean, on my screen, I can see ETFs that are up less than 10%. The top one is a memory one, and that's up over 115% year to date. So you're going to see a wide variety of styles with AI. You could have memory again. You could have the chips themselves. You could have the infrastructure. You can have some focus specifically on power. So, really, I would just say that yes, the AI may be in the name, but a lot of these are going to look very different for the underlying holdings. Now, our thought was let's have the ability, the flexibility to be able to move along the full value chain of AI, and that's really the goal here is to provide the best opportunities, for the portfolio team to find and invest in.
Perfect. Mark, let's maybe begin to wrap this up, and you tell us, where should this fund fit in an investor portfolio?
Yeah, no. So I would just say, a couple things. I think, we see this a lot of those ETFs that I mentioned where you get the 100 billion. Those are very generalized AI funds, Mag 7 focused. So we really see AI infrastructure having very little overlap with a lot of those funds and names that we're holding in there. So we really think we can be a complement on a thematic side to AI infrastructure, to AI exposure that you might have. A lot of times people will say the Qs, for example, that you could be this could be a complement towards. I would also say when you think about more from a portfolio level standpoint, this is a satellite allocation on the equity side thematically, so that core satellite position. And then finally, I think we always see this as an infrastructure allocation, and really Rob can speak to it, but the definition of infrastructure, we've seen that really start to shift. And we think digital infrastructure is a bigger and bigger part of that infrastructure definition. It's grown beyond pipelines, toll roads, airports, if you will, and it's expanding digitally. And really with this focus on this industrial build out. So, I think as you see the maturity in the data centers, in this physical infrastructure, it's going to start to look more like the cash flows that you've seen historically from very large infrastructure projects. We're at a different point in time here where a lot of this is being built, but we think that infrastructure definition is changing on the fly here.
And then,
Rob,
and then,
anything else you'd add there?
Nope, nope. I know. I was just going to say, and then if we start to wrap up here on the next slide, I think one of the questions I mean, as portfolio managers and analysts, we always ask is, what's the valuation look like? And I know this market has seemed frothy for a lot of people, and you look at those numbers on the right or on the left. I mean, with the PE ratios for some of these underlying sectors, and what you're looking at is the price earnings ratio for the sectors for the companies that we've classified as electrical infrastructure, cooling, power, oil and gas production. You've seen those, and you see those. Some of those numbers look a little high. But what I would encourage you to do, and the way we look at it, is we dive a lot more deeper, and we look at the PEG ratio. So we incorporate growth, and so when you factor in growth that's happening, because a lot of these companies that we're investing in are operating in undersupplied markets with accelerating growth, we expect earnings per share growth to be very solid for a lot of, especially the digital infrastructure companies that we're investing in, such that their PEG ratios, as illustrated on the right side, are much more manageable. In fact, much more attractive, even obviously than the S&P 500, and that's why we think that this portfolio has soundly outperformed the S&P 500 and can continue to do that over the duration, as long as the AI theme continues and the AI capital spending train continues. and these AI applications continue. So anyway, with that, Mark, I don't know if you want to talk anything. We're running a little late or long, so I don't know if you want to say any
I
more about
got just
Tortoise
a
Capital. Yeah.
Yeah, I just got a couple quick ones, and just Rob on this valuation. I mean, you make a great point on the AI, but look at the differentiation in the PE ratios, and so there is optionality again, depending on different market environments that you can be, and there's different levers that can be pulled in terms of exposure that you can get here. So I think worth reemphasizing. Rob, I think just two very quick ones that came through that I think everyone would probably benefit from hearing. How do you trim a name that's run, over 100%? And I guess maybe talk generically about, how you guys are managing, just, I guess, specific position level concentration risk. Some of these names have really gone up significantly year over year.
Yeah. So we look at like we obviously look at these portfolio names and how they're performing daily. In my case, and everybody else on the portfolio team, I think hourly. So what would we trim, or when do we trim? Well, obviously we have some. We're a small team, so we can do that at any point in time. But we also have formal meetings where we're always looking at our names and establishing the weights in the individual names we want to own. And on a weekly basis, we meet and talk about the names that have, exceeding those weights. And do we want to raise those weights, or do we want to bring those weights back down to the model weights, or do we want to change the model to what the actual numbers are? So we have a fairly disciplined process to go about that. In As part of our process, though, it really incorporates kind of this review of these subsectors that we do weekly on the various subsectors, and we kind of rotated amongst the analysts and rotated amongst the subsectors to really analyze, how undersupplied are these markets. And so if in the case of things like, and a lot of people have been talking a lot about memory, right? Memory and storage. Those stocks, Micron, and we're gonna see what the results are. Maybe they're out now. I'm not sure. But how they've done. We've invested in Micron. We've invested in Western Digital, but we see that market being very undersupplied, and we see the growth accelerating a lot for memory and storage. And so as a result of that, even though a lot of those names have run really hot, we probably will continue to hold some of those names in a major way. Now we have, we don't have any formal limits, but we know we don't like to let get names above 10%. We like to keep the portfolio fairly well allocated between all the forms of various infrastructure. We know we're not just always going to be digital infrastructure. We're not always going to be energy infrastructure. We keep it fairly balanced, and we within the various infrastructure components, we'd like to keep it balanced between energy infrastructure, power infrastructure, whether it's oil and gas production, whether it's digital infrastructure in the form of data storage or network switches. But we really focus on a lot of that on the PEG ratio to drive us, and then our models to keep us disciplined and ensuring that we don't go above some thresholds that would overexpose us in a particular name.
Okay, one more came in. I'm going to weave it in with the second one that I had for you. I guess the question is, what would have to happen for you to become less constructive on the AI infra thesis? Are there specific indicators that you're watching specifically? And then the last question that came in was on Micron, and maybe just what we're looking at on a duration wise. What data point we're looking at duration wise from the memory pricing cycle, and I'm sure that kind of plays into how you might be thinking about the AI infra thesis and holes that could be poked in it. So what are we looking for to reinforce our bullish thesis on Micron and digital infrastructure there?
Yeah. Take the first question. What are the drivers? What are the big picture drivers we watch? That goes back to that AI capital spending, right? That's the number one thing that we look at all the time and keep our eye on. We talk about every single morning. Are there are there any cracks in that spending? And so far what we've seen is just continued increases in AI capital spending quarter after quarter by those hyperscalers, and that money's keep trickling down into the earnings of the companies that we've been investing in. But that's the number one thing that we'll watch out. Obviously, the AI applications and the advancement of AI and how that's developing is that's more the technology side. Look, I don't know how to develop AI, and that's not what we're focused on at Tortoise. We're not developing models, but we are following the companies that are developing the models, and we're seeing how can AI develop, and I think that most of us would probably agree that the opportunities for AI still seem to be quite extensive, and the move to an AI-driven economy is probably inevitable over the next several decades, which will benefit all of us at TCAI. Micron specifically, it does play in that memory storage area. Like I said, we follow that company very closely. We noticed a huge supply-demand imbalance, basically, in the availability of memory, and so we had a feeling that margins were going to be able to improve. Micron was probably going to be able to increase its prices, and that they were going to continue to sell more units, more storage, because it was absolutely critical. You think about, if we're going to have robots, we're going to need a lot more storage. If we're going to have autonomous driving, these data centers are going to need a lot more storage. So we're still very constructive on the storage and memory sector, and view that as an opportunity here, like I said. And we will look very closely here and read the latest update from Micron that's probably out here. Well, actually, another hour to see if that confirms our views. But we still have a strong conviction in Micron, and we'll still hold that name in the portfolio.
Great. All right, Rob, we answered all of them. I know we ran a few minutes over, but appreciate everyone sticking on. Really enjoyed the conversation today. Yeah, here's our sales team directory. If you have additional questions and you'd like to reach out, we'll keep this on the page. Just want to thank everyone for joining us today. We do monthly webinars as well on energy and all things that are happening with our different investment strategies. That's usually the second week of the month, somewhere between Tuesday and Thursday of that second week of the month. So hopefully you can join us for those. Otherwise, look forward to catching up with you all soon. Thank you, and have a great rest of the week.
Thanks, everybody.